So let me begin by welcoming all of you to this post-MPC engagement. These engagements remain an important anchor for transparency, an anchor for coordination and clarity around our policy actions and expectations going forward. I do value your continued commitment to this format that I have introduced, and I intend to keep it as a standing touch point following every Monetary Policy Committee meeting. So let me begin with a brief update on the policy stance since our meeting last week. At our most recent MPC meeting, the committee unanimously decided to maintain the policy rate at 28%. This decision reflects our commitment to sustaining the disinflation process, which, while encouraging, but is not yet complete. Headline inflation has continued its steady decline, reaching 21.2% in April, supported by a stable exchange rate, tight liquidity conditions, and continued fiscal consolidation. Colleagues, our models now suggest that inflation could reach the medium-term target range as early as the first quarter of 2026, which will be earlier than we previously expected. The CD has also rebounded sharply, as you all are aware, appreciating over 24% against the US dollar so far this year, while the external sector has delivered a record current account surplus and rising international reserves. But we need to put this appreciation of the CD in context, because remember last year we recorded a depreciation of about 19%. So it should not be, fatal as it seems. I see this more as a form of correction in addition to all the other reasons that we have given. In this context, maintaining the policy rate sends a strong signal that we are not loosening prematurely. It provides continuity and certainty as we reinforce price stability and safeguard the hard-won confidence returning to our markets. Now, a few regulatory announcements. The first one has to do with the CRR directive that we amended as contained in our MPC statement. We are actually looking at about 5 key regulatory measures, and let me take you through each of them. So the first is about the CRR directive, which seeks to align liquidity and funding structures. So this directive was announced in my MPC statement, and this came after careful internal deliberation and consultations with some of you. We heard your concerns about the dynamic CRR regime, and we worked to design a solution that is effective but would not inject too much liquidity into the system. Accordingly, with effect from the 5th of June 2025, and that is later this week, all banks must now do 2 things. First one, maintain domestic currency reserves for CD deposits. Secondly, maintain foreign currency reserves for FX deposits. This approach helps better align our liquidity management, your liquidity management with funding structures, and enhances discipline in the foreign exchange market. We trust that the transition will proceed smoothly, and we welcome any operational feedback as implementation begins later this week. Of course, I'm sure you have some questions, and we are happy to provide clarifications during the discussions today. So the second one is on consumer protection and pricing fairness. We've noticed a few issues in that area as well. We've noted a growing trend in the application of optional issuer fees, or what is called OIFs, when it comes to cross-currency card transactions. In principle, We recognize that these fees may reflect real cost. However, opaque pricing and limited disclosure have already begun to erode consumer trust and the integrity of payment systems. To this end, the Bank of Ghana will soon issue a directive, and the directive seeks to do a number of things. It seeks to address gaps in optional user fees when it comes to cross-currency card transactions, and we seek to cap these at 2%. Secondly, we will require the mandatory disclosure of all applicable OIFs to customers before a transaction is completed. Now, beyond this, we are also concerned about broader pricing practices that prevail in the sector. Indeed, we have received reports that some banks continue to apply interest charges on credit accounts that remain inactive. Even though they are inactive, some banks continue to apply interest charges, and this often results in cases where the accrued interest exceeds the original principal. Now, let me be clear, colleagues. Such practices are unacceptable and must end. They distort customer outcomes. They misrepresent the true profitability of lending portfolios, and they violate the principles of fair treatment and transparency. We expect all banks to review their pricing models and ensure that customer charges reflect ethical and commercially defensible standards. The third one is in the area of digital lending. We are currently finalizing comprehensive digital lending guidelines, which will be issued hopefully by August this year. And this also is an urgent and necessary intervention that the bank has to make. Today, colleagues, there are too many Ghanaians, especially young people and informal workers, that are being lured by online lending platforms that make bold promises, often only to turn around and trap them in cycles of hidden fees, harassments, or even worse. We have received reports of individuals being threatened, in some cases, individuals being shamed, or individuals being scammed, all under the guise of assessing what they call quick loans. We cannot allow this to continue, and so we want to put an end to this. The upcoming guidelines, which will be released soon, will bring clear, enforceable standards to both bank-led and non-bank digital lending models. The guidelines will set rules around, for example, licensing and authorization, but also disclosure and interest rate transparency, issues about data protection and customer privacy, and finally, ethical recovery and collection practices. Our goal in this is twofold. We want to protect borrowers, especially the most vulnerable, from exploitation. And secondly, we want to enable responsible, well-regulated digital lenders, including banks and their fintech partners lenders, to be able to thrive. If your institution, colleagues, is active in digital lending, whether directly or through third parties, colleagues, now is the time to review your models and prepare for compliance. Let us work together to build a digital lending space, a space that serves people with dignity, a space that serves people with fairness, and a space that serves people with integrity. Now, let me say a bit on the high NPLs across the industry and what we want to do to resolve them. Colleagues, we will soon issue a comprehensive directive to tackle persistently high non-performing loans across regulated financial institutions. We will consult with leadership of your association before the guidelines are issued. But let me say a bit on what the guidelines are. The measures will, for example, mandate write-offs of fully provisioned loans with no realistic recovery prospects, excluding related party exposures. It will cap NPL ratios at 10% of gross loans by December 2026. The measures will tighten restructuring rules requiring sustained repayment before reclassification. The measures will also enforce timely collateral recovery, especially for overdue loans. And then the measures will strengthen credit risk governance and require proof of effectiveness. The measures will enhance NPL reporting and disclosure with monthly submissions and public transparency. Then finally, the measures will restrict further credit to strategic or willful defaulters and share their identities with key financial sector oversight bodies. As part of this directive, banks will also be required to disclose blacklisted willful defaulters in their audited financial statements, along with sectoral breakdowns of NPL exposures. This added layer of transparency will sharpen both regulatory and investor focus on systemic credit risks. And these actions are part of our broader agenda to restore asset quality, promote sound lending practices, and safeguard the resilience of Ghana's financial system. So let me also touch on another issue that has to do with strengthening local governance and decision-making authority across the industry. Colleagues, we will soon issue a directive that aims to reinforce local accountability and board independence, especially in foreign-owned banks operating in Ghana. This measure responds to a growing concern, and that is the outsourcing of major credit and risk decisions to offshore principals who are not subject to Ghana's regulatory oversight. These decisions are often passed down to Ghanaian boards for formal ratification, which often gives the appearance of local governance, when in fact, core decisions have already been made externally. Now, let me state clearly, Ghana-based boards must not serve as rubber stamps for instructions issued from offshore. No. This undermines the very basis of effective governance and creates unacceptable regulatory blind spots. So the forthcoming directive will clarify that, first, local boards and management teams must retain genuine authority over all material credit decisions and risk management actions that are taken in Ghana. 2, prior approval from the Bank of Ghana will be required before any delegation of key decision-making functions to foreign entities. 3, boards that endorse decisions made without proper local deliberation will be in breach of the Corporate Governance Directive, and that is Section 9 and 13, and may face regulatory sanctions. 4, risk management, ICAP, and capital planning processes must reflect the realities of local governance and local risk environments. And this is in line with Basel II, Pillar 2 expectations. And then finally, institutions found bypassing local governance structures may also be subject to fitness and propriety reviews, particularly where directors are seen to be abdicating their fiduciary duties. Colleagues, this principle is reinforced by the Bank of Ghana's outsourcing directive. The directive will take effect on 1st July 2025. Institutions are reminded to review all outsourcing arrangements, including those involving data, credit assessments, and management control. This is to ensure they meet our supervisory expectations for accountability and resilience. Colleagues, we are also mindful of the broader consequences. First, supervisory integrity is weakened when decision makers fall outside our jurisdiction. Next, legal and data protection obligations may be breached when sensitive customer data is sent offshore without consent in violation of the Data Protection Act, that is Act 843, and the Bank of Ghana's Cyber Security Directive. Then finally, institutional capacity suffers as local professionals are disempowered and denied the experience needed to develop leadership pipelines. So this directive is not anti-foreign at all. It is pro-accountability. It is about ensuring that all banks operating in Ghana, regardless of ownership, are governed in ways that reflect the interests of this market, that reflects the interests of its regulators, and that reflects the interests of its people. We welcome global capital and expertise, of course, but we cannot accept governance frameworks that strip Ghana-based boards of meaningful responsibility. The integrity of our financial system depends on strong, accountable institutions, and those institutions must be rooted right here. The overall resilience of the banking sector continues to improve, as we indicated in the last MPC statement. This is underpinned by stronger profitability and steady asset growth. Recapitalization efforts are ongoing, with encouraging signs of progress in addressing legacy risks. That said, the systemic vulnerabilities we highlighted at our last meeting have not disappeared. The high NPLs, the capital shortfalls in some institutions, and weak credit governance, these still require urgent attention. This is precisely why the policy measures announced on loan write-offs, on NPL caps, and stricter credit risk oversight are all so important. So on the supervisory outlook, our supervisory priorities remain consistent. And those are governance, those are on AML, those are on cybersecurity, on climate risk, and on innovation oversight. We will continue strengthening early warning systems. We will ensure forward-looking supervision, and we will engage more directly with boards of banks. And as I noted in April, we expect deeper accountability and risk culture across institutions, not just compliance. In that spirit, colleagues, let me highlight one emerging area that demands early attention, and that is the regulation of cryptocurrencies and digital assets. The Bank of Ghana is working with the Securities and Exchange Commission as well as other stakeholders, and we are finalizing a comprehensive framework for crypto regulation. This will bring clarity, it will mitigate risks, and it will support responsible innovation in line with global standards. I want to encourage all banks and financial institutions to begin preparing now. We have no choice but to engage. Now, how do they prepare? In a number of ways. Strengthening your AML, CFT, and KYC protocols for digital asset clients. You have to invest in secure IT systems and stronger cyber defenses. You have to engage in the Bank of Ghana's regulatory sandbox for crypto pilots, and we will come out later on these. You have to educate your customers about the risks and the rules of crypto use. And then you have to assess your own institution's exposure and readiness for crypto-related activity. This is no longer a theoretical issue. The market is evolving. Recently, I had a conversation with someone who was telling me about how banks in Somalia are thriving, the way they are going about with their international transfers. These are huge volumes. They are not making use of SWIFT. They are not making use of any of the frameworks that we have. But it is going on, and it is large volumes. So we cannot rest. We have to move on too. Now, for my closing reflections, colleagues, we are in a new phase of Ghana's recovery, where confidence is returning and macro fundamentals are strengthening. But this phase also requires more discipline. It requires greater fairness in conduct, and it requires deeper alignment between policy intent and market behavior. The Bank of Ghana is committed to its part through credible policy, timely regulation, and open dialogue as we are having this morning. We count on you as leaders of your institutions to match this commitment in how you lend, how you price, how you disclose, and how you innovate. Together, colleagues, we can anchor this recovery on a foundation of trust, on a foundation of transparency, and on a foundation of shared responsibility. Certainly, I look forward to deepening this partnership in the months ahead. And I want to thank you once again for your time and for the work you continue to do to strengthen Ghana's financial system. I thank you very much for your attention. Thank you.